for reaction to the market sell-off. I'm joined by Anthony Chan, Chief Economist with Chase. Anthony, good to have you with us as always.
Glad to be back.
So, Anthony, we had relative stability over the last 2.5 weeks or so, and then today, the crash of Monday, down 8.5%. What happened?
Well, you got to remember that after stability and we saw some of the economic fundamentals that were not that great. We saw the flash purchasing manager survey again coming in below 50. That raised some concerns that the economy is softening. But again, never lose sight of the fact that there's an avalanche of monetary stimulus that's in the pipeline. We've seen a couple of interest rate cuts, a couple of reserve requirement cuts. Those have not impacted the overall economy and, of course, the equity markets yet. We'll see that in the second half of the year. Investors would like to see some evidence that it's working before they start to re-engage again.
Do you think that evidence will come through?
Not only will that evidence come through or that stimulus comes through, it always does. A Nobel laureate told us that monetary policy has long and variable lags. But additionally, I believe that central bank will, in fact, ease policy even further from here, adding even more stimulus to the overall economy.
Well, that seems to be what everybody's banking on, that the Chinese regulators will step in, that the People's Bank of China will come in to the rescue again. But is that really such a wise policy?
I think it is a wise policy if it impacts the overall fundamentals of the economy. It is not as wise, of course, if you have investors thinking that regulators are tinkering with the financial markets. And one of the things that investors are dealing with right now, they can't decide whether it's a good thing or a bad thing. We heard some rumors before the market opened on Monday that regulators were stepping back,
right,
and that caused the market to go down, which you would think, ironically, that if the regulators are stepping back and not stimulating the economy as much or trying to stabilize it, it's a positive. But as I said,
confidence returning.
The market is just unsure. Over long periods of time, it is a positive development.
Well, to reassure investors, Chinese regulators said that they will continue to purchase stocks. Is this a good idea?
Well, I think that if you do that on a sustainable basis, it's not necessarily the best thing you can do. But at the same time, it's not the first time. Hong Kong has done it. Japan has bought more than $23 billion worth of equities. So it is, and by the way, other central banks that are buying bonds, there's really no difference. As long as you're adding liquidity to the market, the Chinese central bank and authorities are not the first people that are the first central bank doing this.
But they've received a lot of criticism for this. Many people are saying that this intervention by regulators is not in line with the free market, that by stepping in, they've sent out a panic signal, if you will, that it's 80% of retail investors and they have a herd mentality. And when regulators take such drastic measures, it sends a red flag, a panic signal that they're basically just gave a short-term fix, and that it set the precedent for more action every time there's a correction. On the other hand, people have been saying 80% of this market is retail investors, mom and pop investors, and the government had to do something. What's your position?
Well, first of all, those retail investors, are more than a third of those are young people, which means that they have a long time to be able to wait until the market comes back. But at the same time, the bottom line is we need to see the fundamentals in the Chinese economy improving. We are, in fact, going to see that. In the second quarter, GDP actually sequentially improved, and we saw the trade numbers that are improved. There are some numbers that are still not great, but we are seeing at least some evidence.
But do you think the economy and the stock market are really that linked? The stock market was up 150% year on year, even as we saw this new normal take hold, even as we saw the GDP growth decelerate, and yet the stock market seemed to be operating separately from the fundamentals.
You've got to remember that the Chinese equity market is still a relative adolescent. It's a 25-year-old market. The market is still finding its way. We are in agreement here because at the beginning of the year, the equity market was doing great. The equity market was doing great, but the economy was softening. Then the economy started improving in the second quarter, and the equity market plunged. So there does not seem to be that strong link. But over long periods of time, you'd like to believe that in a mature and, in fact, well-functioning equity market, the two have to be linked in some way.
In the big scheme of things, we're talking about a 30% decline. Now, when the market's up 150%, that doesn't seem like a bubble pop. That seems like a correction. Has there been overreaction to this?
I think there's been an overreaction. The Shanghai equity market, even with that 8.5% decline, is still up a whopping 15.2% on a year-to-date basis.
Right.
And that greatly pounces the kind of rates of return that we're seeing in the United States. Well, in fact, you're seeing about a 0.4% increase on a year-to-date. So that is pretty impressive.
Anthony, do you think we're going to have a continued sell-off now?
I think that over the near term, there is a lot of anxiety. Investors will need to see at least some evidence that the stimulus is actually working, or at the very least, some evidence that policymakers are going to do more as an insurance policy.
Do more? What more can they do?
More monetary stimulus. Believe it or not, real interest rates in China are still relatively higher than they are in the United States. So there's a lot of room for them to actually expand monetary policy.
But what about all these restrictions have been in place? No IPOs, a restriction on people holding more than 5% from selling stock for the next 6 months, a restriction on short sellings. At some point, these restrictions will be lifted. What happens then?
I think what you have just outlined are some of the restrictions and some of the changes in policy that investors don't view as friendly. But once investors start to see changes in policy that are actually going to result in better economic fundamentals, confidence will come back. But certainly these artificial changes in policy make investors nervous, and I think policymakers are getting the message, and they may, over the next couple of weeks, start to focus on changes in policy that impact the fundamentals rather than just try to stabilize the equity market.
Okay, we'll see what happens. We're going to have to leave it there. Thank you so much, Anthony Chan, Chief Economist with Chase.